Welcome to International Taxation Inbound Transactions, presented by Northeastern University's DeMoore McKim School of Business. I'm David Hardesty, and I'm the lead faculty person for this course. No graduate course of study in taxation is complete without a thorough examination of the issues associated with the taxation of inbound transactions. The taxation of inbound transactions refers to the U.S. taxation of income earned by non-resident alien individuals and foreign entities from sources within the United States. Inbound taxation encompasses all of the U.S. tax rules associated with the taxation of U.S. source business income and non-business income earned by non-U.S. persons. Inbound taxation also covers income taxed in the United States under tax treaties, which can include both U.S. source and non-U.S. source income. Inbound taxation does not include foreign taxation of U.S. taxpayers. That topic is covered in a separate course of study titled International Taxation Outbound Transactions. So first, let us go over the main objectives of this course. As I said, no graduate course of study in taxation is complete without a thorough examination of the issues associated with inbound transactions. The objectives of such an examination and the objectives of this course are to gain an understanding and a working knowledge of the following. The overriding objective is to understand a foreign person's tax liability in the United States. Whether our job is to advise foreign persons on their personal U.S. tax liability or to prepare tax returns for foreign persons, you need to know how to determine U.S. tax liability. In all cases, we will study general principles of U.S. domestic tax law applicable to all taxpayers, including the identification of U.S. income and the requirements for U.S. withholding on that income. And we will learn how tax treaties modify domestic tax rules, including the way they reduce or eliminate tax on income that is otherwise subject to U.S. tax. We will study the difference between taxation under U.S. domestic tax law, which is the U.S. code, regulations, cases, and rulings, and U.S. taxation under treaties, which is based on the rules specified in tax treaties. And we will examine issues unique to specific individuals, such as determining when a foreign individual is a U.S. resident, and the applicability of a tax treaty to a foreign person. Let us now turn more specifically to what we will be looking at in this course, starting with the classification of taxpayers as foreign. Foreign taxpayers in this course include non-resident alien individuals, foreign corporations, foreign trusts, and foreign estates. All of these are taxpayers who may be required to pay U.S. tax. There are also foreign partnerships, but we do not focus on them in this course since they ordinarily do not pay U.S. tax. In general, non-resident alien individuals are non-U.S. individuals who do not meet the requirements which we will study to be classified as U.S. resident aliens. Foreign corporations are generally foreign entities classified as corporations under U.S. tax law, which are not incorporated in the United States. Trusts and estates are classified as foreign based on a fairly complicated set of U.S. rules, which we will study. The next topic of study is U.S. taxation of non-business income. The U.S. generally taxes the non-business income of foreign taxpayers, regardless of whether those taxpayers have any connection to the United States. Non-business income is usually limited to dividends, interest, rents, royalties, and income from certain personal services, plus other fixed determinable annual or periodic income. We usually call this FEDAP income. Non-business income is taxed in the U.S. at a 30% rate unless a treaty applies to reduce that rate, and no deductions are allowed against this income. U.S. source capital gains can be subject to U.S. tax as non-business income. For non-resident aliens, however, special rules apply to determine taxability. Non-business income ordinarily does not include gains on sales of U.S. real property. These gains are subject to special rules, which we will discuss later. A key issue which we will study is the income tax withholding on non-business income and other income of foreign taxpayers. There are three significant areas in which income tax withholding is required with respect to foreign taxpayers. The first is income tax withholding on U.S. sourced non-business income. The second is income tax withholding on income from dispositions of U.S. real property interests. And the third is income tax withholding with respect to foreign partners. There are also three issues that apply to these kinds of withholding, and we will study each in detail. The first is the type of income subject to withholding. The second is determining the person responsible for withholding and remitting the tax. And the third is claiming the benefit for withholding by a foreign person. After looking at non-business income, we will study the taxation of business income. A foreign taxpayer is usually taxable in the United States on business income only when that income is effectively connected with a U.S. trade or business. Accordingly, we have to know when a U.S. trade or business exists. This is a special area of study. In addition, effectively connected income ordinarily includes only U.S. source income, so the source of income is also a special topic of study. Note that a U.S. trade or business is not necessary for non-business income to be taxable in the United States. It is only necessary that the non-business income be sourced in the United States. Also, gains on U.S. real property sales are taxed regardless of the existence of a U.S. trade or business. Source of income is the next area of study, and it is important to the taxation of both business and non-business income. Under U.S. domestic tax law, the U.S. taxes a foreign person only on income that has its source in the United States. There are exceptions to this rule, among them tax treaty rules, which do not rely on U.S. sourcing rules. Different sourcing rules apply to different types of income. The major categories of income to which specific sourcing rules apply are inventory sales, rental and lease income, sales of personal property other than inventory, royalties and similar fees from the license of intangible property, and income from personal services. The corollary to the source of income is the source of deductions. Here we are talking about only deductions relating to business income, since no deductions are allowed against non-business income. Most of the deductible expenses of a foreign taxpayer are allocated between U.S. and non-U.S. source income pro rata, according to the foreign person's relative amounts of U.S. and non-U.S. source income. However, special allocation rules apply to many types of deductions. We will focus on the special rules applicable to the deductions for compensation and fringe benefits, research and experimentation expenses, and interest expense. U.S. business income is taxed at regular graduated tax rates, and deductions are allowed. In general, once we determine that there is a U.S. trade or business, then all U.S. source business income is treated as effectively connected with that U.S. trade or business, and is taxable in the United States. We ordinarily refer to this income as effectively connected income, or ECI. Gross ECI is reduced by applicable deductions to produce taxable ECI. Taxable ECI is taxed at regular tax rates applicable to U.S. citizens, residents, and domestic corporations. We are not finished with the taxation of business income. Foreign corporations, not individuals, are subject to another level of tax known as branch level taxes. A foreign corporation owner of a U.S. trade or business can pay a branch profits tax at 30%, which is in addition to tax on taxable ECI. The 30% branch profits tax can be reduced by treaty. A foreign corporation is subject to the branch profits tax, or BPT, on deemed distributions from a U.S. trade or business, in a manner similar to receiving dividends from a U.S. corporation. The BPT is the equivalent of a tax paid by a foreign corporation on a dividend received from a domestic corporation. Other branch level tax rules apply to interest paid by a U.S. trade or business. Special rules apply to the income from the rental of or gains from the sale of U.S. real property. These rules override the general rules for the taxation of business and non-business income. In general, U.S. real property rental income that would normally be treated as non-business income may be treated as business income at the election of the taxpayer. When it is, the foreign taxpayer is able to deduct expenses against the income for U.S. tax purposes, and the net income is taxed at regular U.S. tax rates. U.S. source capital gain, which is ordinarily taxed as non-business income, subject to special rules for non-resident aliens and is often exempt from tax, is taxable in the United States if it results from the sale of U.S. real property. Finally, special income tax withholding rules apply to sales of U.S. real property. The final area of study in this course is U.S. tax treaties. The first topic is whether a tax treaty applies to a particular foreign taxpayer. The United States has treaties with around 60 countries. It is necessary that a foreign taxpayer be covered by one of those treaties before we can try to apply a treaty to reduce the taxpayer's tax. A taxpayer can apply a treaty if the taxpayer is eligible to use the treaty of the taxpayer's country of residence. In certain cases, even if a taxpayer is a resident of a country with which the United States has a treaty, that taxpayer cannot claim the benefits of that treaty. Finally, we have to determine how the particular tax treaty applies to a particular transaction. All treaties have differences, some minor and some major. The most significant effects of a tax treaty are as follows. Business income must be attributable to a permanent establishment in the United States before it is taxable. This is a higher standard than the one discussed earlier, requiring business income to be effectively connected with a U.S. trade or business. The tax on many types of non-business income is reduced or eliminated under U.S. tax treaties. Tax treaties can have the effect of exempting a foreign taxpayer from all U.S. tax. So there you have it, a complete outline of the objectives and topics covered in this course. You should next listen to the lecture on the operation of the course. However, before moving on to that lecture, let me make a few final comments on the importance of understanding the taxation of inbound transactions. Cross-border transactions between businesses or between businesses and their customers have been increasing rapidly ever since the fall of the Berlin Wall and the end of the Cold War, over 30 years ago. The rise of electronic commerce as a major component of international transactions, beginning around the turn of the century, accelerated the pace of cross-border buying and selling. With the United States, one of the world's biggest consumer of goods and services, the amount of inbound transactions is huge and growing. It would be very unlikely that a tax professional would not have to face tax problems associated with one of these transactions. The price of not knowing how to prepare a tax return for an inbound transaction or how to advise a foreign client on the U.S. tax treatment of such a transaction can be great in terms of tax penalties, loss planning opportunities, and unhappy clients or employers. So this course is an absolute requirement. Again, I want to welcome you to the course, and I look forward to a fast-paced but fulfilling 7 weeks as we explore this fascinating subject.